Hey, good morning, everybody. It's Tuesday, June 25th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, July corn down 5 at 428.5. July soybeans were down 5 3/4 at 1169.5, and July Chicago wheat was down 3.5 at 549. This morning, we had an export sales announcement of 209,931 metric tons of corn to Mexico. 22,098 of that was for 23, with the balance 187,833 coming for 24. Yesterday afternoon, crop progress and conditions report was released. Corn came back 69% good to excellent. That was versus 72% last week. Soybeans were 67% good to excellent rated versus 70% the week before. Winter wheat conditions improved slightly up to 52% good to excellent. Spring wheat conditions came back 71% good to excellent. That was a significant increase over 67% from the previous week. And winter wheat harvest caught some eyes, moving along pretty rapidly here at 40% harvested. That was versus 27% the week ago and 25% on average. With that, guys, we've got some weather moving across kind of the upper Midwest, moving a little bit into the Eastern Corn Belt here. Weather models, still for the 10 to 14 day appear to bring rain to various areas throughout the Corn Belt. Feels like we're still trading that. So, Justin, maybe a few thoughts to get us rolling this morning, and then we'll throw it around the room.
Yeah, we talked about yesterday. Forecast kind of flipping. It's still kind of fighting on where that ridge goes. I mean, either way, we've gotten rains in some areas that really needed it. I would say the exception so far has been the southern half of Illinois, probably southern half or 2/3 of Indiana and south and east of that. And then obviously the far northwest being, arguably way too wet for a big portion. So obviously some really good areas in there that have caught some really timely rains and are going to be looking really good. And then how does the forecast look, the next couple, 2-3 weeks? Again, disagreement on where that ridge sets up. And we got some pretty good, weathermen that think it'll, kind of be that same kind of a pattern, where that areas to the south and, east of that line kind of continue to miss out on meaningful rains and kind of stay drier. And then that northwest remains kind of a well above average rain. So again, just kind of, seeing how that plays out. Obviously the funds have been, continuing to sell. The technicals have turned down. We made new contract lows yesterday, both corn and soybeans. So it's just the favor is definitely on the bear side right now and on the technicals and path of least resistance. So, we talking about, on a fundamental standpoint, I still believe we're probably have a friendlier balance sheet than last year in corn. And we've already taken out last year's lows yesterday. So we were, talking about kind of why that would be on such an early date. It could be a lot of different factors, especially when we have, good demand. One being, I think crop insurance, you had a much higher floor the last couple of years because of your base price, so you had floors in that, depending on your coverage level, anywhere from the upper fours, 490 down to, 450, where this year you're, closer to $4 and lower, on those coverage levels. Some people that have obviously really premium, MP policies or ECO, which is a very small portion of the growers out there, certainly, are in payments in several areas with clients that we work with. That's a small, very small portion of growers. So, overall, I think there's just a lot less coverage because we started from a lower point. And that's just talking structurally on, where that inherent put floor, kind of rests for the corn belt in general. So it doesn't really mean anything here, but I think when it looks at like the general corn and soybean farmer and how they market, last year, a lot of growers were able to rely on crop insurance during the break. Now, what happened after crop insurance expired was kind of a debacle because a lot of people didn't sell it, and then we broke substantially after that. But for this time of year while crop insurance is active, I think that is maybe a substantial reasoning for, maybe a lower floor just with that inherent put that's out there with crop insurance.
Yeah. Dustin, you got something to add to that?
No, I think he's absolutely right. Like, whether there's invisible hand that doesn't allow crop insurance payments to be paid, which is like a common conspiracy spouted, right? Or it's actually all of these market participants, consciously or even subconsciously knowing that they're in a payment and then starting to pull back on those sales, is what makes the market stop going down. A lot of times we've seen that in some of the bigger bear market years where we crashed prior to that harvest price, and then we found a rebound right into the harvest discovery, in part because they had pulled back on selling, knowing they were in a payment. And I think that is something the market is impacted by. But I will also say there's a couple other things to this too. Like you've got most people took Art County that we've seen on corn. I mean, there's some that took PLC because of SCO, but Art County, payments, assuming average yields, think of it like in this is oversimplification of it because it's a marketing year average price that's decided on this. But think of it kind of like a 420, 380 put spread for a lot of growers, right? Like that's about where, you end up getting, that full Art County payment under average yields using a marketing year average for the year. So there's some other comparative advantage payments that would come, if we came all the way down, let's say someone is 25% sold even, there's actually more revenue projected at $3 corn than there is at $4 corn because of all of these things that would kick into gear. Now there's still going to be bigger problems at $3 corn because what it means for next year for 25 and what it means for soybean payments and soybeans. But, that's kind of the thing to kind of keep in mind, I think, is one of the worst possible settlements for the year would be right around like a $4.10 to $4 price in October. So, solving for that is something to probably consider, especially if you're an 85% policy holder and you're in an area with relatively good yield prospects right now.
Yeah, Ben, we saw, from in the Eastern Belt, just most notably, Ohio fallen from 73% good to excellent to 60, and Indiana 71 to 63. So, we'll hopefully some of these rains that are moving through kind of catch a few areas here and improve that. But what's your thoughts this morning coming?
Yeah, over the weekend, there was some rain in those areas. It was not great. It wasn't widespread. And amounts were 4/10. We need a rain, especially when you get south of I-80. That's kind of where the northern edge of that ridge is set up. So we need it here. It looks like we're going to get a pretty good shot later today. And we'll see if that storm that's moving west to east starts to head south to get more coverage. So we certainly could use it here.
Yeah. A couple thoughts on the markets.
We've talked about this heading the first notice day for corn with a flip on the weather models, which that happened over the weekend, and we're gonna have to get into this report. We have to get through first notice day. It's the mechanical purge. We've seen it repeated over and over in bear markets. And see who wants to step in and take the other side of it. And then to Justin's point, it seems that we a little bit early year over year, when you look at the fundamental outlook, that we're basically 60 cents lower than we were this time last year, 55, however you want to look at that, with some fundamentals that are probably not any worse than last year at this time, maybe more supportive, and we'll get more information on that come Friday. So
very good. Rylan, a couple thoughts on livestock here before we get started.
Yeah, well, we had kind of an interesting response to the cattle on feed report. There's just a huge range of trade and like really right on the open. And then the front end of the market stayed really strong. Triple digit gains in June and August. I mean, we're narrowing the basis up with June coming into expiration here at the end of the week, and now the focus and the volume is really on the August right now. So let's try to narrow that basis as well. And just with the sharply higher cash prices, the front end was really well supported. Even though the report was a negative report, we saw a little bit of that in October and December, but the strength of the front end really held that together. So overall, the cutout's been really strong. You saw a higher beef market yesterday. Everybody's waiting to see if packers are going to still just keep on paying up for cash. You know, the northern regions are still at a really big premium, but there is an expectation that supply availability is going to be a little bit more prevalent, I would say, in July. So we'll see if those numbers come to fruition. Maybe the discount on the board is right. But overall, it seems like we're getting a little bit more support here in the front end, maybe some new length, maybe some new speculative longs, just with the cutout hanging up really well. We're seeing the trimming market still on fire. You know, it's burger season, so imagine that those are going to hold up for the time being overall. Hogs, kind of new lows for the move here, not going to, you know, new contract lows, just, and it looks like with the build and open interest, I think everybody's expecting that this is going to, you know, as we were kind of alluding to in some of our commentary, that funds are probably going to build a pretty hefty short position, you know, after just coming from very, very long in the market trading contra seasonally, just no real support in the cash market. So hopefully we can get a little bit better of a sentiment there, but overall it just seems like the speculative community just wants to stay short right now, and everybody's just waiting for maybe a little bit of an uptick in seasonal pork demand, but we'll see. So we'll see, maybe there's going to be a surprise in the export market. You know, maybe some of this weakness in grains adds a little bit support here, but we'll see.
Well, very good. Appreciate
You know,
Go ahead,
I would
Ron.
also add, you know, we talk about this July 1st notice date period, and we saw really similar price action last year when we broke from 630 all the way down to 490 heading into the end of the month. So this is not, you know, from a mechanical standpoint, we're not having an unprecedented event. Once that pressure was off, we had a really strong snapback. I'm not saying that that's going to happen this year. Every year is different, but the mechanical pressure, and now going on close to, you know, 10 months of a big burdensome overhead supply has really not, it's kept anyone from any sort of true fear. Now we're going to have, like most years, we're going to have some really good this year. We're going to have some really bad, but it'll be interesting to see when we get to end of month, end of quarter, a pretty hefty short position, how people want to treat the grain markets, in particular corn.
Very good. We a couple things to point out. So we've referenced a number of times here. USDA report will be out at 11 o'clock Central on Friday. We will also have a bonus war room edition at 11:15 Central time. So we'll have some thoughts and comments on the numbers once we have time to digest there. So everybody be sure to tune in. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate all the thoughts and comments this morning, guys. A good conversation. Hope everybody has a great day, and we look forward to talking to you tomorrow.
Thanks, Dan.